This is Aditya from InCred. I manage the healthcare portfolio here at InCred. Over the last 2 years, the BSE Healthcare Index have not performed up to our expectations. While the top line growth of low to mid-teen certainly existed even over the last 2 years, the reason why these stocks did not perform very well was actually margins. China over the last 2 years have been on and off in terms of production because of their zero COVID policy, and that created an acute shortage of raw materials for healthcare companies over the last 2 years. This acute shortage was obviously followed by higher raw material prices, which became difficult to pass on to the consumers, and hence the gross margins of the healthcare companies in India were severely impacted. To add to this, freight cost and power cost also went up more than normal, and that also impacted the EBITDA margins of these businesses. However, beginning first quarter FY24, what we are beginning to notice is that China has come back in full swing in terms of production of chemicals, and local Chinese consumption really isn't back to normal. Hence, there is a larger than usual surplus in China of chemicals, which they are more or less dumping in the countries which buy chemicals from them, one of the larger buyers being India. Hence, what we expect in the coming 12 months is that the raw material prices for pharma and healthcare companies in India would significantly come down from what it was in the last 2 years and will be very close to the pre-COVID levels. However, the healthcare and pharma companies over the last 2 years have taken price increases, and as we understand in this sector, the prices just go one way up. They generally don't come back down when the raw material prices come down. So what we expect in the next 12 to 24 months to happen is the prices of the products and services will still remain up, whereas the prices of raw materials would soften significantly. This would lead to expansion in gross margins, and we hope that in a year or two, we will see gross margins being reinstated to the pre-COVID levels for healthcare companies. On the EBITDA side, the freight cost and power costs have also begun to normalize. Last 2 years was a period of commodity inflation, which reflected in higher freight cost and higher power costs, but now commodity deflation is helping the raw material, the EBITDA margin also to come back to normal. As both these factors play out, we expect the EBITDA growth in our InCred healthcare portfolio to be higher than usual, which is we expect more than 30% EBITDA growth for our portfolio companies on a weighted average basis this year. This 30% EBITDA growth would be accompanied by a 40 to 50% PAT growth due to operating and financial leverage, and that should reflect in returns for our potential and current shareholders. It will also result in probably a good amount of multiple re-rating. Just to remind you, healthcare as an index is trading below its historical average in terms of price to book and at its historical average in terms of EV/EBITDA. Now, EV/EBITDA isn't really the right measure to look at today because your past 12-month earnings are actually suppressed. So the EV/EBITDA multiple artificially looks inflated, whereas price to book is a much better multiple to look at because it is accumulated earnings. Both depressed and inflated earnings of the history are reflected in the price to book multiple, and hence when that multiple shows a significant discount to historical averages, it to us indicates a bottoming out of the valuations for the sector. We remain highly optimistic of the healthcare companies. These business models are non-discretionary, robust, and highly cash generative, and that do not require debt and are not capital intensive. Our larger picks today are hospitals and diagnostics because these two sectors are seeing secular growth and really coming back with volume growth post-COVID. Within pharma, we are very selective. There are pockets of very, very expensive valuations, especially around commodity generics. So we are not looking at that closely at this point, but we are looking at branded generics where there are pockets of very, very interesting valuations. And we believe there's a lot of alpha to be made in this space in the next 24 months. Thank you.